About 40 years ago or so, I was at a Bob Seger concert. Now, if you're under 60, you can look him up, Seger. The concert was great, but even better than Bob were his backup singers. And I remember watching the show, just being mesmerized by how on pitch they were, how their harmonies just blended in so perfectly. And I still think to this day, even though they sort of blended into the background, if they had screwed up, it could have ruined his entire concert. So you're probably wondering, why the heck am I telling you the story about Bob Seger 40 years ago? Well, believe it or not, this story relates to stocks and bonds, and something that happened yesterday we could all learn from today. You were cruising through your day, everything was good, and then around 1 o'clock Eastern, you glance up at your screen and this is what you see. Out of the blue, in what had been a pretty good day in the markets, boom, everything crashes and falls, wait for it, like a rock. You can look it up. That was the stock market equivalent of Bob Seger's backup singers screwing up. But the villain in this case was that lowly, mostly largely ignored US bond market. And in this video, I'm going to explain to you why it all happened. But first, I want to step back and get a higher level 30,000 foot view. So Canada and the US here, we are both moving closer and closer to that line that we just don't want to cross. And that is the point where our rising debt becomes too much to manage. And when it looks like we might reach that point, the markets are going to react, and they're going to react hard. And that's what we saw yesterday. In the US, of course, the big driver right now is Trump's newly passed big, beautiful bill, which just cleared Congress overnight. And in Canada here, it's more of sort of a slow burn of decades of public debt, the holdover still of the pandemic era spending, and then there's the growing weight of our aging population. Hey, I'm part of that group. Sorry for all of the hassle. But I want to break it all down here. What just happened, what is changing in the bond market, and what it all means for investors and for the broader economy. So first of all, let's look at the immediate backdrop. Yesterday, all of a sudden, the Dow plunged more than 800 points. The S&P 500 dropped 1.6%. The NASDAQ fell. In Canada here, the TSX went right along for the ride. And what caused it all, what flashed red, is that mysterious bond market. No big stock market news, no late-breaking tech news, but the bond market. And at the same time that the market sold off, U.S. Treasury yields spiked. It's a bit hard to see in this chart here, but that yellow line is the U.S. 10-year, and that spiked exactly when the markets sold off. And it was the spike that caused the sell-off, not the other way around. We can see here the 10-year crossed 4.6%, the 30-year spiked above 5%, and these are levels that we haven't seen in quite a long time. In Canada, the 5-year government bond topped 3%, and these changes are going to impact everything from mortgages to business loans. Then, after the markets closed, overnight, Congress passed that controversial big, beautiful bill. So let's look at what happened with yesterday's trigger. Short version of a long story here is there was a 20-year bond auction in the U.S., and it was a disaster. I'm going to let a few of the headlines that came out yesterday tell the story. Why the bond market is suddenly freaking out over the big, beautiful bill. Barron's says 20-year Treasury auction goes badly, yields spike as bonds sell off. Treasury yields soar as ballooning U.S. deficit worries Wall Street. And the bond auction yesterday was the weakest that we've seen since February. And in this case, investors demanded significantly higher yields. Essentially, they're saying, we don't trust the debt path that the governments are on right now. We need compensation for that risk. And that is a very clear, very loud message that they're sending to Washington. Now, why does the bond market, you might ask, care so much about debt? Well, let's just sort of drill down here. Bond investors, they're the ones who are lending money to the government. And when they lose confidence in the fiscal discipline, regardless of what the government is, whether it's here in Canada, whether it's in the US, they're going to demand higher interest rates to keep lending more. And higher yields mean governments pay more to borrow. So do households, mortgages, credit cards, auto loans, businesses, of course. That raises the cost of investment for them, and that might impede their expansion. And we are already seeing this play out. As I mentioned, yesterday's $16 billion U.S. bond auction absolutely flopped. Moody's has just downgraded the U.S. credit rating. Foreign investors are growing a little bit tired, a little bit wary of buying U.S. treasuries. And even Trump himself, he's raised concerns about what he calls this yippie bond market, a golf term. He said recently, well, I thought that people were jumping a little bit out of line. They were getting yippy, you know. They were getting a little bit yippy, a little bit afraid. Now, I want you to think of something here. America's interest rate bill this year alone is expected to be $684 billion, and that's 16% of the total federal spending, and that is just to service the debt. It doesn't pay it down. That's just to cover the interest. Here in Canada, similar story. As we sit today, Canada's debt to GDP number is somewhere between 70% and 110%. depending on what you're measuring. If we look at the federal government debt or market debt, that's sitting at 70% according to CEIC data. If you look at the broader definition, which includes federal, provincial, and local and municipal governments, that's sitting at just over 110%. Neither of these numbers are good. Now, in a report that came out in January of this year, the Howe Institute says Canada's public debt should be reduced by about 10 percentage points of Canada's GDP to ensure fiscal policy can be used to cushion the effects of future economic crisis. It goes on to say, since major crises happen frequently, prudence suggests that the target should be achieved before the decade is out. And that would mean boosting the primary balance by about 1.4% of GDP, so that would be roughly $43 billion a year. And there is a sense of urgency here. And that's because the next crisis, so whether that's a recession, whether it's another pandemic, something like geopolitical shock, that will hit, right? And if we don't have some wiggle room, if we don't have some fiscal space, then the government won't be in a situation that is able to respond effectively. And on that note, we're already seeing cracks. If we look here at home, Ottawa is on track to spend around $47 billion this year on debt interest, and that will climb to around $64 billion by 28-29. And that is crowding out all the other priorities like education, infrastructure, and innovation. So that is a lot of tough news that I'm kind of sharing with you today. It does get worse. Even though Canada can borrow from abroad, that does introduce new risks as well, like losing investment income to foreign creditors and weakening our current account balance. If we raise taxes to cover rising interests, well, obviously that has costs too. Howe economists, they estimate the drag on the economy could be as high as $75 billion. That would be due to lost work, savings, and investment incentives. So this kind of explains why that sleepy bond auction yesterday, which most people had never heard of, in fact, leave a comment if you even knew it was happening, that suddenly sent the markets crashing, and it's because the bond market is the true fiscal test. And when we look at both the US, we look at Canada, the math right now is changing fast. If we look at Trump's new tax bill, that's projected to add $3 to $5 trillion to the U.S. debt. And it passed even after the CBO, the Congressional Budget Office, warned that it would further destabilize America's fiscal outlook. The Treasury is now going to have to borrow more, just as bond investors are demanding higher yields. So you can see why there's a lot of skittishness out there. That does put America in a tighter spot. It could force them to cut programs like Medicare just to cover the interest. Now, we're not immune here in Canada, where there are similar conversations are starting to happen. The Howe Institute held a major fiscal conference in May of 2024, so almost a year ago now, perhaps a little bit out of date, but their warning was blunt that we are not on a sustainable path. That hasn't changed, whether they said that last year or whether they said that this year. So where does that leave us? The short answer here, it leaves us with some very, very tough decisions that we're going to have to make in the coming months and years. First of all, the U.S. bond market, as we can see, we saw this yesterday, they're pushing back hard against all the fiscal recklessness that we're seeing. It is true that Trump may have won the short-term victory with that tax bill, but that comes with potentially a massive long-term cost. If we look here in Canada, the danger is a little bit more subtle than all the news coverage we're getting these days in the US, but it is just as real. We look at our debt that might not be growing as quickly as the US, but also our demographics, far less forgiving. And we look at the costs here of aging, we look at the costs of healthcare, pensions, elder care. Those are going nowhere but up. And that's why economists are calling for these particular solutions. First off, multi-year binding spending caps. They're calling for value for money audits of public programs. That makes sense. And a rebalancing of responsibility between Ottawa and the provinces. When we look at generational accounting, that shows that without any adjustments, today's newborns will be paying more in lifetime taxes than they'll ever get back in services unless we start consolidating something now. And if we look at that from a personal perspective, and I'm going to be becoming a grandfather again in about a month, again, a second granddaughter, and it's not just about the numbers in this case. I look at it from a fairness perspective, and do we want new children to be coming into the world today without that hanging over their head? I know I don't want to, and I'm sure most people don't as well. So look at the outlook. If we see these trends continue, then Canada's federal debt to GDP market, that market debt that I talked about earlier, that could pass 100% by the mid-2030s, and that is definitely danger zone territory. According to the modeling by the Howe Institute, there is only about a 20% chance that we can avoid that unless we take some real deliberate action now. Meanwhile, in the US, the bond market clearly is trying to sort of force something. They're forcing a reckoning upon the US government, and whether Congress listens, that of course is an entirely other matter. We are seeing the markets already pricing in the future of tighter credit, more expensive debt, and less flexibility. The question is, from a political perspective, will the policymakers wake up now? Are they just going to kick this can down the road like they always seem to do until the next crisis hits? Here is the trillion-dollar question, literally $1 trillion. Should governments cut spending? Should they raise taxes? Or both? More importantly, of course, will they actually do it? Let me know what you think in the comments. Are you concerned about these rising debt levels? Do you think the bond market is overreacting? Or is this showing us a preview of what's to come? As always, thank you so much for watching this video. Take care, and we'll see you in the next video.